Are financial catastrophes as random as they seem? Or do they share specific patterns? Some common threads weaved into the chaos? Today, we're taking you through the captivating insights from the book, A History of the United States in 5 Crashes by Scott Nations. We will examine how these significant market downturns have shaped our financial world and America's financial destiny. The first market crash we will explore is the Panic of 1907. In 1906, San Francisco was dealing with the aftermath of a devastating earthquake. The city, home to over 400,000 people, saw more than half of its population lose their homes. In the face of such a disaster, people resorted to extreme measures, setting their own homes on fire to cash in on their fire insurance. Many of these insurance companies were based in Britain. Consequently, the Bank of England, tied to the gold standard then, was paying out a hefty sum in insurance claims. To recuperate, it began offering higher interest rates to borrowers. Back in the US, trust companies, less regulated than banks and maintaining less collateral or equity on their balance sheets, leveraged these higher interest rates to attract customers' deposits. This backdrop set the stage for a severe financial crisis, instigated by a failed attempt at stock manipulation on United Copper, which dramatically dropped its stock value. This shockwave spread rapidly, hitting banks and corporate trusts who had used the stock as collateral and sending depositors into a panic frenzy to withdraw their money. The result was a spate of bank runs and a precipitous plunge in the Dow Jones. From a high of 103 in January of 1906, the market plummeted to a staggering low of 53 by November the 15th in 1907. As the pillars of the financial world crumbled, JP Morgan orchestrated a rescue mission, pumping in money and restoring faith in the tottering banking system. Despite this tumultuous period, the market showed its resilience. By the end of 1909, it had regained almost all of its lost ground. The Panic of 1907 showed that unchecked speculation and manipulation could result in severe financial instability. It was a costly lesson, but it set the stage for the creation of a centralized banking system, marking the birth of the Federal Reserve System in 1913, which created a much-needed safety net for the banking ecosystem. The lessons learned from the Panic of 1907 weren't enough to prevent the catastrophic Wall Street crash of 1929. In the era known as the Roaring Twenties, optimism ran high, and speculative trading reached unprecedented levels, leading to a massive bubble. The bubble frenzy picked up steam in 1924 when the Federal Reserve slashed the discount rate to a record low of 3%. Effectively opening the floodgates of cheap money into the American stock market. Stocks became easier to finance and bonds more attractive to purchase. Meanwhile, unsatisfied with the low interest rates, corporations and affluent individuals started providing call money, loans primarily used for stock market speculation that offered slightly higher interest rates than the banks. The stock market morphed into a magnet, drawing hordes of new investors, many of whom were trading on margin, using borrowed funds. The market peaked in September of 1929, and by October 29th, the bubble had spectacularly burst. The bubble burst was initiated when a prominent investor in London named Clarence Hatry was found to be a fraud. Hatry duped banks into lending him money, using counterfeit stock certificates as collateral. The shocking revelation made investors question the fundamental legitimacy of their own certificates. As the market started to slide, brokers issued margin calls to heavily leveraged individuals and investment trusts. Unable to meet these calls, stocks were quickly liquidated, spiraling the market into the Great Depression. The Dow dropped to a devastating low of 41 in July of 1932, even lower than the bottom of the Panic of 1907. The stock market fell almost 90% from its peak of 381 on September 3, 1929, and would not return to its 1929 levels until more than 25 years later. The Great Depression is a stark lesson in the dangers of unchecked speculation and the fragility of investor confidence. The roaring market of the 1920s was fueled by optimism and cheap money, but it ultimately led to the biggest crash in history. It is a reminder that while innovation and growth are key drivers of our economy, they must be tempered with regulation and prudence. Fast forward to 1987, the year of the Black Monday. This crash was primarily due to an innovation known as portfolio insurance, a financial product designed to protect investors during market downturns. For a small upfront fee, portfolio insurance promised to shield portfolios from dropping below a certain level. However, it turned out to be a ticking time bomb due to its flawed assumptions when implemented on a large scale. The two most critical assumptions were that stock prices move smoothly and that there would be enough liquidity for all the sell orders necessary to hedge against a downside. The catalyst for the crisis arrived on October 19, 1987. The US attacked Iranian military targets in the Persian Gulf, creating a perception of war and triggering an initial downturn in the stock market. The slide activated portfolio insurance sell orders, creating a domino effect. The market was ill-equipped to handle the flood of sell orders, triggering more sell orders and so on. This chain reaction was the genesis of Black Monday. The Dow fell by an alarming 22.6% on this day, recording the most significant single-day loss in stock market history. It took 2 years for the market to claw its way back to pre-crash levels. Our fourth stop is painfully recent, the Great Recession of 2008. Central to this crisis was the creation of mortgage-backed securities, which are constructed by pooling a portfolio of mortgages. Theoretically, these portfolios could be secured if composed of carefully selected borrowers, providing attractive returns relative to government bonds. But the underlying reality was far from ideal, as mortgage issuers relaxed their lending standards and issued ninja loans. Loans to individuals with no income, no job, and no assets. Mortgage issuers were incentivized to offload risky loans to other investors, who then packaged these into mortgage-backed securities. The rating agencies responsible for grading securities based on default risk gave many of these subprime mortgage-backed securities AAA ratings, signifying the lowest possible default risk. The faulty logic was that by piling enough subprime loans together, diversification would render the overall investment safe. This further fueled borrowing and the system's over-reliance on continuously rising home prices. The house of cards came tumbling down when borrowers started to default on their mortgage payments. Home prices began to decline and accelerated as more borrowers defaulted, setting off chain reactions throughout the financial system. The crisis point was reached when investment bank Lehman Brothers declared bankruptcy on September 15, 2008, highlighting the perilous interconnectedness of financial firms. The Dow peaked on October 9, 2007 at 14,164 and hit rock bottom on March 9, 2009 at 6,547. The market did not recover to its pre-crisis levels until March 5, 2013, illustrating the severity and lasting impact of the crisis. Finally, we look at the flash crash of 2010, which is a stark reminder of the dangers of over-reliance on computer algorithms in trading. Unlike Black Monday of 1987, where human error played a key role, the flash crash of 2010 was primarily driven by computer algorithms. On May 6, 2010, as riots erupted in Greece, a financial firm called Waddell & Reed sought to hedge its portfolio before the market closed, using an algorithm provided by Barclays. As Waddell & Reed initiated large-scale selling, the algorithm misinterpreted the increased volume as higher liquidity, triggering even more sell orders. The selling quickly spiraled out of control, rapidly eroding market liquidity. The Dow plunged 9.2% within minutes, but recovered most of its losses that same day. Although it lasted only 36 minutes, the flash crash underscored the potential pitfalls of financial innovation and showed how high-frequency trading could disrupt the market. You may have noticed common characteristics between most of these crashes: the advent of new financial innovations, the use of excessive leverage, and strong market performance just before the crash. The specific catalysts varied, but the stage was set for a significant market downturn with these conditions in place. On the other hand, despite its ups and downs, the market always rebounded. This resilience is the silver lining that makes investing a rewarding journey for those who weather the storm. But the question remains, have we learned enough to avoid the next big crash? Or better yet, to profit from it? Drop your thoughts in the comment section below. And as always, if you found value in this video, give us a thumbs up and hit that subscribe button. Until next time, keep investing and stay savvy.